man, I got $1,000. What should I invest in? Like, just buy an ETF or something. Oh cool, yeah, which one? The one that tracks the market, you know? I don't know, man, there's a lot of options. Which one should I get? They're probably all the same. Definitely incorrect. The common mistake I see a lot of beginner investors make is not doing enough research on the ETFs they're buying and not subscribing to my channel. I do financial tips for Canadians in my long form content and financial comedy in my shorts. We are so close to hitting 1,000 subscribers, so help me make that a goal before the end of the year. With that said, let's continue. Even if different ETFs track the same indexes, there still might be some slight differences. Take a look at these two ETFs for example. VFV and XUS both track the S&P 500, but the MER for VFV is 0.01% lower. Essentially, for every $10,000 you invest per year, you're saving like $1. It's really not a lot, but these are the subtle differences that people should be considering when they're buying ETFs. So let's talk about the 5 things you should look for when you're buying an ETF. First and foremost, you want to look at what the ETF is tracking. All ETFs track some type of index, whether it's the S&P 500, Dow Jones, or NASDAQ, or even some random market in Asia. The point is, they're all tracking something. So familiarizing yourself with what the ETF is holding is very important. And the reason could be because you don't want to buy an ETF that has a huge overlap with another ETF that you own. That means you're probably investing in the same products. And that kind of defeats the purpose of investing in an ETF because you kind of want to buy ETFs to diversify your portfolio. Now, ETFs overlapping is not always a bad thing. Let's say you buy an ETF that tracks NASDAQ and you buy an ETF that tracks the S&P 500. If that's the case, there's going to be overlaps between the two ETFs. And that's fine as long as you have proper diversification. But if you buy an ETF like the VFV and you buy another ETF like the XUS, both tracking the S&P 500, then yeah, it kind of defeats the purpose of diversification. The second thing you want to look for are the fees. Different ETFs that tracks the same indexes could have different fees. We just had an example earlier with VFV and XUS, which is a great example. And yeah, that's only $1 for every $10,000, but it adds up, especially when it's essentially the same product. And you'll realize that ETFs with a little bit more niche could have higher fees. ETFs in Canada could have fees between 0.06% to 1% or even higher in more extreme cases. ETFs that track the S&P 500 or the Canadian TSX tend to have lower fees due to the number of competition of the ETFs out there. Because in reality, there's a lot of companies that's offering the exact same products that's tracking either the S&P 500 or the TSX index. And plus, it's very popular among Canadians to be investing in those, which lowers the fees if the companies want to remain competitive. However, if you want to invest in an ETF that focuses on tech, like TXF, you're gonna have to pay 0.7% management fee. And that might not sound like it's a lot, but over time, especially with compound interest, it adds up. And this is why I prefer investing in ETFs over mutual funds. Mutual funds are just way too expensive. At least for me. Most of them are charging you over 2% management fee for a portfolio manager to manage your funds. And the reality is, most portfolio managers can't beat the market in the long term. And 2% average management fee for mutual funds is just insanely high. Imagine paying $200 for every $10,000 you invest. The third thing you want to look for is the risk tolerance for each ETF. It goes without saying that not all ETFs have the same risk factor. You can usually get this information when you research the ETF on the ETF's website. ETFs that focuses on bonds, for example, might have lower risk than the ETF that follows the tech industry, for example. Your risk tolerance is very important in choosing the right ETF for you. So I'm in my 30s, so I can afford to be a little bit more risky in my investments, so I can invest in tech ETFs, for example, or even NASDAQ. Very little of my investments is invested in bond ETFs. And that might change in the future as I get older. The fourth thing you want to know about buying an ETF is the level of assets inside the ETF. Banks that create the ETF run it as a product, so they have to make money, meaning the expense ratio of the ETFs must cover the overhead cost, the admin fee, and much more. If the ETF becomes unprofitable to run, it will have to be liquidated. However, unlike stocks, you don't actually lose all your money when the ETF gets liquidated. The ETF that you invest in is still worth the market that it tracks. The real downside is that you're forced to sell all your shares. And if you didn't invest your ETFs in a tax savings account, you'll be taxed capital gains. On top of that, it's just inconvenient. To reduce the chance of this happening, you want to invest in an ETF that has at least $10 billion under its assets to ensure a healthy product. But then again, it isn't like a huge risk, but it is something to consider. Last but not least, always check the trade volume for the ETF. Just like a regular stock, the more people that trade the stock, the more liquid the stock's gonna be. The same thing applies to ETFs as well. The more people that invest in the ETF, the easier it is to sell the ETF. Now, you might wonder why that's important. For ETFs, you have what's called a spread, just like a regular stock. The spread is what a buyer is willing to pay versus what the seller is willing to sell the stock at. So if the trading volume is low, the spread could be very huge, making it less likely for you to liquidate your stocks at the desired price. Same thing with ETFs. Even though ETFs tracks indexes, spreads do happen to a lesser extent. So investing in an ETF that has higher trade volumes ensures easier liquidation. Now, an honorable mention on what you should look for if you're buying an ETF if you're Canadian is if the ETF is hedged, especially if the ETF holds foreign stocks, like the S&P 500. In a hedged ETF, it's designed to mitigate the risk of foreign exchange, whereas an unhedged ETF doesn't. So let's for example talk about the S&P 500. If you're investing in an unhedged ETF, if the US dollar gains value compared to the Canadian dollar, and because you're investing in a US fund, your ETF will gain additional value. However, if the Canadian dollar appreciates, then your ETF will lose some value. In general, unhedged ETFs are slightly more risky. So if you're young and can take the volatility of foreign exchange rates, I would go unhedged. Thank you for watching this video. If you haven't already, please remember to subscribe and like this video. And again, we are so close to hitting 1,000 subscribers. Whether you're a fan of my shorts for financial comedy or just watch my long form content for financial tips, I appreciate the support and I'll see you next time.